welcome to this week's episode of the Hidden Money Podcast. This is the third in a series on tax planning, and today we're focusing on what is tax planning for high income earners. I'll tell you what it is, man. It's magic. It can be. I can't tell you how many clients I see or new prospective clients I meet with or people at the party, they come to me and they say, man, I am finally, all the work is paid off. I've gotten through my internships. I'm finally making good money and I feel just as broke as I did before. It's all going to the government. That's when you need to consider tax planning.
That is. And this specific episode, we want to really hit the high income earners because let's just be honest, there's more options. If you have money, you have options. Does it mean you have less problems? No, more money, more problems.
Huh.
But if you have money, you have options. And so we always like to look at our kind of high net worth individuals, very personalized. So you might have a different family situation. Estate planning may be kind of one of your top things. I have 3 kids and some grandkids, and I have a very successful business, and I don't want my kids to inherit this business and just get destroyed in taxes. There's tax advantageous ways to check and to structure an estate plan, which we partner with estate attorneys for this.
Let me just mention on that one. So I met with this guy who was in that same situation, had grandkids and kids, and he's like, I said, what are you doing for estate planning? He said, you know, they're just gonna sell the stuff, what do I care? Well, what happens when they sell the stuff? This is what I told him. What happens when they sell the stuff and they only get to keep half of it because the other half is taxed? Or not even 2/3 of it will they get to keep. Is that gonna bother you? You worked your whole life for that. And then the guy said, you mean there's an option? And we showed him how the beautiful thing of step up and basis. That's not really income tax, and that's not where we focus on. But if you are a high income earner, make sure you're not working your whole life to build up something so that the government gets it when you die, or so that the government gets it when your kids sell it. I mean, that guy was not a taxable estate. Now you have to die with over $15 million before you pay estate tax. But again, his kids and grandkids were going to sell this stuff. They were going to pay tax if he did it the way that he was planning on doing it, and we changed that.
Yeah, and if you're over that 15 million threshold, you do have what's called estate tax. And so that means when you pass away, your heirs or whoever receives this money is going to be taxed at a very high rate really quickly. It jumps like almost 40% real quick. So you want to make sure that we can get things out of your estate. So typically what you do when you sit down with an estate attorney is we diagnose kind of where your assets are. Do you have some rental homes? Do you have businesses? Do you have pension plans? We take a look at the whole financial landscape, and you can develop trusts. You've even worked with some offshore trusts. Very creative with like creditor protection and stuff. I would love to hear
rock solid creditor protection. But I mean, I don't want to spend too much of this episode discussing things like that. We should do a series on estate planning, or at least an episode on estate planning, because I think most of you, just like us, we're not at the point where we're worried about estate tax yet. You should be, and you should always be planning for it. And Kevin and I have pretty nice wills and trusts set up to ease the burden on our family and to ease the tax situation. But right now, most of you, like me and Kevin, we're trying to build up our net worth. We want to have an estate tax problem one day. We're trying to build it up. And if I give the government 35, 45, if I'm in a high tax state, 55% of every dollar I make, I got to work twice as hard, 3 times as hard. When you consider the time value of money and the power of compounding, you give the government 40% today, that money could have worked for you in 10 years, could have been 400%. So tax planning for high income earners, man, this is key. Kevin mentioned this again. It's like you have to, high income, you have more opportunities for tax planning and more problems. But also, tax planning gets more valuable the more tax you pay. You don't pay a lot of tax if you're not a high income earner. I mean, it feels like a lot, but generally, you look at our marginal tax rate system and how it graduates up at each different income threshold. If you're a high income earner, you're paying more tax, more percentage of your take home pay than people that aren't high income. That tax you're paying, it shouldn't be all paid to the IRS. That's not how our tax code is designed. That's not being a good steward of all that hard work and all those efforts you put into it. It is yours to keep. It is yours. It is rightfully yours. Don't just throw it away, please.
Yeah.
So let's talk about
we don't want to. And so when we're talking high net worth, that term could mean a number of things. People might have their own definition of kind of high income earning. What we consider kind of where high income earning starts is with the accredited investor test. If you're an accredited investor, if you're making as a joint tax return $300,000 or more on a joint tax return, or $200,000 on a single tax return, or your net worth is $1 million or above, not including your primary residence, if one of those two are true, you're considered an accredited investor. Then once you start getting into that status, if you're an accredited investor, the world opens up to what you can actually do. So this is where I was saying you kind of have a little bit more options, is because if you are an accredited investor, you can start investing into different products that aren't available to the general public making $100,000, $200,000 a year. You have options to save on taxes and grow your net worth.
Yeah. It bothers me, though, that only high-income earners are allowed to make these accredited investments, and I think we need to change that, and there's a lot of movement in Congress to change that, because it's not fair. The rich get richer. The people trying to scrape by should get richer, too, and have the opportunity. And let Uncle Sam pay for part of their investments. Let them subsidize the growth of their portfolio, like, honestly, is available for the rich. But again, this is for you, the high-income earners, this podcast. There is so much that you can do. It gets hard to know, where do I start? I mean, that's it. It's most people don't love tax like you and I do. They don't love tax code. They feel like tax, the way I feel about dealing with my insurance agent, that's how they feel about taxes. The way I feel about dealing with my doctors and going to my annual physical, that's how they feel about taxes. And it sounds very complicated and very overwhelming. So Kevin, simplify it a little bit.
So when you're in the realm of high income earning, typically you can outsource a lot of stuff. Like you're probably already outsourcing your lawn care at your primary residence. You're outsourcing a lot of already services in your personal life. CPA could be one of those. We could do accounting, bookkeeping. That's where it just starts, is having a conversation. What are your biggest needs? And then diagnosing where your tax problem is, because then we could develop a plan around that problem. We had some clients that are hitting off on some tech stocks that are getting multi-million dollars. They have different problems in that range than maybe someone who's self-employed making $2 million, someone who sold stock for $2 million. Think about GameStop. We had one client make killing in that GameStop blip probably 3 years ago.
Yeah.
Way different tax problem, way different tax strategy for that than our W-2 earners who are making the same.
Let me just throw in there real quick. In that year, for this particular client, I mean, they'd spent most of their life just barely making good money. They were high income earners, but they weren't rich, right? That 1 year, those 2 years that those stock options went up, that was their windfall years. And if they hadn't a tax plan, that's when they were going to pay the most in tax than they had ever paid, and it was going to be gone forever, outside of their portfolio, outside of their control, into the toilet at the U.S. Treasury Department, where it just disappears and gets wasted. So think about it, though. When you have windfall years, man, even if you hate the idea of thinking and talking about tax, those are the years you got to, because you don't know if you're ever going to be blessed with another year like that. That year, it's important to not overpay your taxes, but every year is important, right?
Yeah, and you just have to start with a conversation. And you don't have to understand the Internal Revenue Code. We're highly educational. I can cite Internal Revenue Code all day to you. I don't need you to know it. I need you to know that we understand the code and we know how to implement it. And as long as you have trust in your CPA that we're doing everything that we can to legally reduce your tax bill, I don't need to educate you on the Internal Revenue Code. We have education. We have 20 plus years of experience doing this, where I don't need to bypass that. I just need to show you the playbook and the game plan for your specific situation, and then rely on our team to help implement it. And then if you need accounting, if you need payroll, we'll work out all those details. There are going to be some logistical administrative things in here. If you need a trust, if you set up multiple LLCs in the state of Texas, for instance, you're going to have to file reports every year, but we do all this. And you can outsource it. So don't get overburdened or just saying, oh, I'm too busy, because typically people making this amount of money, they're busy.
Gosh, yes.
I'm talking to a surgeon tomorrow, and we have a standard process of coming to consult with us, and he's like, I don't have time to go through this. Can you just call my cell phone? Like, these guys are going, right?
In between surgeries.
In between surgeries. Yes. He's like, will you just call me real quick? I don't have time to go to your link, and it's like, it's super simple link, but I understand.
Yeah.
He's making a lot of money, and he has a very short window where he can work stuff. He does not need to know the entire internal
And for someone like that, who really doesn't have the money. They're in their prime working time. They don't have they have the money, sorry. They don't have the time to focus on this stuff. Their tax plan is going to look a heck of a lot different than from someone else who's maybe able to spend 10 hours a week on some new investment ideas or business ideas. It can look incredibly different. The same income earner, if you have two people walk through our door making $1 million a year, good chance their tax plans are going to be completely different. Their tax strategies are, because the tax strategies have to fit with what works for those people. It's got to be curtailed and specifically designed for that person and their spouse, that person, their spouse, and their family, the stage of life they're in, what they want to do, what they're into. Yeah. The tax tail should never wag your tax planning dog. It should be your life. It should incorporate what you want to do in life, what you're comfortable doing, and what you're excited about.
Yeah. So for that doctor that's in between surgery, I'm going to recommend some passive ways to utilize the Internal Revenue Code. Passive just meaning I don't need anything from you. I don't need your time. I don't need your attention for it. I just need to educate you on the front end of the risks and what you're investing in. But outside of that, I got the tax plan covered and you're done. And you're passive, you're done. I have some people who want to be more in the details and managing their rentals and making sure that this $1 million asset that they just purchased, we're going to harvest the tax benefits, but they want to actually cash flow this, their hands in. And that's okay too. Everyone's different.
Hope you're enjoying this episode of Hidden Money. I want to remind you that not all tax preparers or tax advisors are created equal. As a matter of fact, most CPAs out there are just tax preparers. Do you want a tax advisor? You probably need one, or at least a good tax strategist. We have a great firm at Revo Taxpayer Advocacy that can help you. We offer free consults. Just go to our website, revotaxpayer.com, click the button, and talk to Kevin and I, and let's see how we can change your life by saving your taxes. We have people in the middle or just past the middle of their career that are making good money, but they're starting to realize this is not what I want to do for the rest of my life. They can use tax planning and tax strategy to get the government to help them start a whole new business that can eventually be their new careers that they are enjoying in life. Get the higher, that's the beautifulness of our Internal Revenue Code. If used properly, you can utilize it, leverage off of it to help you accomplish what your dreams are and keep your hard-earned money all at the same time. Get the IRS to help pay for your new business.
And think about this, and this is always kind of eye-opening, and I just literally had this consultation yesterday. A doctor, he's a MD that's been in practice for 15 years. He's making over $1 million this year. Recently got married. His wife was making $150,000 at her W-2 job. We set a 2-year plan in place. One very easy thing is I'm going to try to partition their income on 2 different returns. That's step 1 for this year. Now, if we can transition her out of her W-2 job, he's making $1 million, and then in the future years 1.5 as these surgery centers kick in. He could be making $2 million. The $150,000 that she was making, you can save more in taxes by leveraging that spouse if she was to pull away from her job. So if she quits her W-2 job, and they want kids and everything, and we could work this tax plan with kids, they eventually want children, but she's going to achieve real estate professional status. So they have a passion for real estate. So they want to scoop up 2 or 3 or 4 rental properties a year and then develop this 20 rental portfolio, and she's going to manage all of that. And I'm going to leverage her real estate professional status, which I need her to get her W-2 away, but we're going to leverage real estate professional status to use his income to buy rental properties, have her manage it, and then her management of these rentals are going to save more than probably $300,000 to $400,000 in tax a year. So she's getting rid of, from a very high level, what she's doing is she's backing away from $150,000 full-time W-2 job at 40 hours a week. She's going to work 15 to 20 hours being self-employed in real estate, saving the family $300,000 to $400,000 in tax a year.
Not to mention the properties she's managing are going up in value. So she went from making her family $150,000 a year to, after you discount it back, after 20 years, maybe she's making $600,000 a year, $650,000 a year for her family. I hear that argument or that concern a lot in these kind of situations. The spouse says, look, my wife can't do all the work and make all the money. I want to feel like I'm contributing to this family. Let's take a step back and look at how you contribute the most to it. But that's not the only way. I'm sure most of our listeners have heard of get a spouse that's a real estate professional. That is a great way. I mean, an amazing way.
It's going to work perfect in this example, yeah.
It is. But it's not the only way. If that's not going to work for you, I mean, I have begged my wife to become a real estate professional.
You got 3 kids. It's not
gonna
possible.
happen. And it's not just 3 kids, it's my 3 boys. And that.
And you.
So yeah, she's raising
She's
4
gotta manage you.
boys. She's raising 4 boys, one quite old and the other 3 quite young. It's not in our cards. That doesn't mean we're not saving a lot in taxes through our tax strategies every year. So what does it look like for high income earners to do tax planning? Kevin mentioned starts with a conversation. Understand first diagnose what your tax ailment is. And then start working with it. Just like we keep talking about doctors this podcast. But I mean, just like you and any doctor with a problem, they start figuring out what are your potential problems. Then they start walking through potential solutions until they solve it to the best, in the best regime of treatment for that particular patient. It doesn't look the same for most people. It's going to look different.
Yeah, and it's not too late. As you listen to this podcast, it's not in December yet. You have to the end of the tax year to do something, and there's passive ways, going back to my example of who I'm talking with tomorrow. I'm in between surgeries, I'm doing all this and that. We can cut your income in half just by implementing some passive strategies between now and year end. If you have the risk tolerance, which we walk you through, if you have the disposable income and to actually invest and you're accredited, we'll educate you this at no cost up front. We want to educate you and see if it's a right fit for you, and then you can make the best decision with you. And we like to partner with financial advisors. We rarely like to work in a silo. Sometimes we do. Some people just manage their money themselves, but I always recommend if we provide any sort of tax plan, we get with your financial advisor to make sure this deployment of cash is in line with your whole financial plan. CPAs are a lot of times we get focused on tax mitigation, but you have to step back and saying, all right, I'm going to actually use cash to mitigate my tax. Is this in line with my financial plan? And we don't have vision to your investments. We don't have vision to your retirement plan. So we need to work with your attorneys, with your financial advisors. So that's probably step 2 is have a conversation. Then step 2 is we're going to develop a team. We need a team. We need a financial advisor in the room. We need an attorney. We need a CPA. Those are 3 different skill sets looking at 3 different areas of your life, but holistically as a team, we can actually get a holistic plan for you.
If that team's not getting together, what generally happens is they're working against each other for you. They're all supposed to be working for you, but then they're working against, your lawyer's working against your CPA, your tax strategist.
Not on purpose, but maybe by accident.
And your tax strategist is working against your financial planner because they're not in the same room talking. All 3 of those areas, in some cases there's 5 or 6 areas that you need your board of advisors there. They need to be working together for you and what you want to do.
Yeah, so always advise we get a team together just because there's so many facets of your life that need to be covered.
You mentioned that it's never too late, but let's talk about this honestly. And again, this is the big problem that we have with most of our high income earner clients is they are so busy. We talk, they love the idea, but then life gets in the way. It does that for all of us, right? Life is hard. Different stages are hard. Life takes a lot of time. So they wait and put it off and put it off. This time of year, November, December, tax planning, the options have gotten to be much less. There's many fewer options to take now for the 2025 tax year. But we got hundreds, literally hundreds of options for 2026. The sooner you start in the year, the better. But it's generally not too late, never too late. Although you call us, when we're off for Christmas, it's too late.
Yeah,
I'm taking my vacation.
Yeah. I want to give one more example in this short amount of time, just because this will show kind of some of the options available too. That I had a client that actually had a lot of staff and a lot of potential clients at his house. And he had a really nice house. He had a multi-million-dollar house, and he enjoyed cooking. He was a chef, but he also ran this business. And so he would have a lot of people come once a month So 12 times a year, he would have host parties. He would order nice food. He would cook it. They would use the outdoor kitchen, the indoor kitchen. He had a game room. He had the whole access of this house was available for 12 times a year. Well, we were able to get up over $120,000 of deduction for that. That was paid from the business to him personally, that wasn't taxed. And that's using the Augusta rule. So
That was a great point, though. You didn't change anything. He was already doing it.
Mm-hmm.
He just was not aware of the tax benefits there. He was spending this money for two reasons. One, he enjoyed it. Two, it was helping out his business by growing his client and employee relations, right? And just by taking what you're already doing, and this applies to a lot of high income earners already, there's probably things that you're doing that could already save you taxes. It's just not being
You're
utilized.
doing some wild things. You're hosting parties. You are doing trips. Could those trips be business or not? Probably. If we have something to tie it to a revenue stream.
Yeah.
But it's really just, and this guy, for instance, he's like, oh, I've been taking the home office deduction for years. I'm like, yeah, I see the home office deduction, but what you just told me is you're renting your whole house 12 times a year. That is different than you working every day in your home office. This is a different thing.
Yeah.
So we were able to capture $120,000 more of deduction than just by changing, and he's been doing this for years.
Yeah.
And he came to us, and then that saved him about $35,000 in tax. He's been doing it for 5 years. 35 times 5.
$350,000 he has overpaid in tax, right?
No, not
Was it 10 years or 5 years?
Yeah, 150.
All right, so $150,000 over the last 5 years.
And it would have been no additional cash outlay for him. It was literally just finding out what he was doing in his business and in his life, and understanding and applying tax strategies at a big level to what he was already doing.
So in that example, what could have that $150,000 done for him over the past 5 years? What would it be doing for him now?
Yeah.
What it is doing for him now is nothing. But over the next 5 years, it's going to be doing a lot more. So what does it look like for you to begin tax planning as a high net worth income earner or high income earner? Change your facts. Change it up a little bit. Boldly retake what is rightfully yours. It's your turn to do it. It's your time to shine. Come on, man. Just change your paradigm. Let's do this. You don't need us. Listen to the podcast. Make your tax strategist work with you, or come see us at revotaxpayer.com.